Broadcast is live.
Okay, here we are. Voila, we are live together.
There we go.
I think we're good.
Gotcha. Yeah, I see you and hear you.
Okay, fantastic. So, right, perfect. Thumbs up. First time. I'm Sean Shackleton with the Shackleton Group at Platinum Living Realty, selling real estate, and I brought on today Roland Bennett, mortgage broker, to talk about what is going on in our worlds as it kind of pertains to what's going on in the world with the coronavirus. So we kind of made some notes so that we don't get off topic, because he and I are very passionate about what we do and can get off topic very quickly. So let's start with, I think, maybe the first thing that everybody's hearing about, kind of besides the coronavirus and all of that, but what's going on with rates? Because everybody wants to talk about, the Fed rate got cut to zero, and what does that mean? Can I go get a mortgage for zero? Should I refinance now? All that. So give us your thoughts.
Yeah, all mortgage rates are 0%. So no, the Fed rate to zero was really a move to kind of pump liquidity into the markets. I think to understand, we kind of have to sort of back up a little bit to, understand what got us to that move that they made, and then how that affects like rates going forward.
Right.
And I'll try not to do it. I'll try not to go back too far.
Right. It's hard.
I know. So the Declaration of Independence was signed, and no. So as everybody knows, the whole news of the coronavirus spreading could possibly affect other countries started kind of in mid-February is when the media started to get on board. I mean, it really came full force in March, but it really was out with some fears in equity markets and stock markets in really January that rolled into February. And then so you started to see the market correction starting in mid to late February, where stocks were starting to go down a little bit. And some people are saying, oh, it's just a normal correction. We needed it. They were getting out of hand. And, anytime you hear stocks at an all-time high, never been 29,000 at the Dow Jones, then that, well, it'll probably dip down and continue to go up. But then what happened was the sell-off continued. And rates started dropping. Mortgage rates have already been pretty much low anyway. I mean, we kind of bottomed out rates in 2016. If you bought a house or refinanced in 2016, you remember being in low to mid threes. And then lately they've been low to mid fours or low fours, high threes, kind of area since the end of 2019 into the beginning of 2020. And then the stock market started selling off. And what happened was, typically when stocks sell off, the big institutional Wall Street money, when it leaves the stock market, it goes into a safe haven of the bond market. And when money goes into the bond markets, driving the bond prices up, that's what drives rates down. So interest rates and bond prices move in opposite directions. So when money leaves the stock market, that's because the Wall Street investors are fearful of maybe this is the beginning of a bull market. or a bear market, let's get the money out of stocks and let's put them into bonds where they're safe. And so that started happening. Then there was the rush of the refinancing, and buyers that were out there shopping were like really stoked because they had just been qualified at 4%. And now they're hearing they can get 3.25 or 3.5 or 3%, which is making their payment lower. And everybody's very happy up until March, up until like the first week of March, when everybody started getting a little scared, hearing the news coming out regarding the coronavirus and how it's going to affect us, and that we may need to be careful. But everybody was still rushing out to refinance, and on March 4th, rates kind of bottomed out because the 10-year bond had sunk to an all-time historic levels. As far as the percentage on a 10-year bond, stock market was, selling off, and money was flowing into bonds, like what normally happens. And then there were so many people in line for the refinance, did not want to bottleneck and put a blockage on underwriting, especially for all of the purchase buyers out there. So they added a fee to refinances at the end of that first week of March to say, we got to stop these refi applications because we have people buying homes. We're just gonna make it more expensive. And then what happened is the news over that weekend, which was March 9th, was a Monday. I believe that was the weekend where the Utah Jazz player tested positive, and they shut the NBA down. And then they shut college sports down. And then March Madness was canceled. And then the PGA, and then schools. And then now everybody's just flipping out because America shut down on March 9th. There would probably be some rock and roll songs sung about that day. And what happened was, when everybody was now in line, and starting to hear about the low rates, my neighbor just got a 3%, or I just got a 2.99. Well, I want to refi too. Everybody that came late to the party to that found that rates weren't that low anymore. And the reason why is because 2 weeks ago, when the real stock market sell-off started, just every day, thousands of points a day, money was not being taken out of stocks and put into bonds. Money was being put into cash because the investors were fleeing from all the markets. So normally that money that would go into the bond market, dropping the rates, there was a bond sell-off also. And money was being pulled out of stocks and being pulled out of bonds, specifically mortgage-backed security bonds, which is what directly affects mortgage rates, not the Fed rate. So the Fed rate is just what they allow the banks to borrow money at to then lend out to the borrowers. The mortgage-backed security bonds, the prices on those are important because that's what directly affects the Fannie Mae and Freddie Mac and FHA, VA 30-year fixed, 15-year fixed, 20-year fixed mortgage rates under $729,000. Agency Fannie Mae loans that are being packaged into those mortgage-backed security, investment portfolios, and sold on Wall Street to investors and bought and sold every day. The investors were bailing and taking off, sending rates to a spike. So they dipped, then they spiked. And then because those mortgage-backed security people thought, oh my gosh, we just shut America down. Nobody knows how long it's going to be. People may not make their mortgage payment, and we're going to see 2008 all over again. So then the Federal Reserve stepped in and said, okay, we're going to make an emergency move. We're cutting the bank rate to zero to pump liquidity back in the market. And not only are we going to make the Fed rate zero, which has a direct effect on home equity line of credit rates because those are tied to the prime rate. So now everybody's home equity line of credits are cheaper. Their credit card percentages are cheaper by a point. A week prior, he dropped it a half point. The Fed's dropped it a half point. The next week, 1 point. So in 2 weeks, you saw a 1.5% drop in the Fed rate, which is a direct reflection to auto loans, credit card loans, home equity loans, not necessarily 30-year fixed mortgage loans. Those are more tied to those mortgage-backed security bonds. But then, so the Federal Reserve said, not only are we dropping the rates, but we're also going to buy $700 billion worth of mortgage-backed security bonds and treasury bonds to stop this upward spiral of interest rates that started due to the fleeing of not only the stock market, but also the mortgage-backed security market. So now the feds are buying those bonds back to bring rates back down so that mortgage rates don't get out of hand. And they've come back down.
Right.
So as the stock market is doing this, the bond market is doing this. So it's just a matter of, when you lock a 30-year fixed, you don't want to lock it when it does that. You want to lock it when it does that, on a day that the feds maybe are purchasing bonds.
Right.
So I listen to a lot of, if you really want an in-depth information on this, the people that are listening to this, just Google Barry Habib. This guy he's the CEO of MBS, Mortgage-Backed Security Highway is his company. He is so smart. He's the leading person with the most knowledge of mortgage-backed securities and how it directly affects mortgage rates. And what he was saying is he's saying, chill out. What's going to happen is effectively, mortgage rates did spike in the last couple of weeks, but what they're going to end up doing is tapering down due to the liquidity that the Federal Reserve is pumping into the bond market and the bank rate being low and the Federal Reserve being low. And it's all kind of what happened after 2008, which dropped rates to their all-time lows. And we've been at all-time lows for like 10 years.
Yeah.
We haven't seen, maybe for a very short period of time in 2017, we were locking 5%. But they've been in the 4s now for the last couple of years. And then they started getting into the 3s. And according to Barry and his projections, they're probably going to remain very low throughout the rest of the year. And now it's looking like into 2021, just due to how long now it's going to be. The longer we're shut down, the deeper the recession goes, the longer rates will most likely stay very, very low to help sections like housing.
Right. And so just so that people know, again, I get asked this all the time because I sell real estate. What's the rate? What's the mortgage rate right now? And because I don't do mortgages, I don't know on a daily basis. I mean, I can tell people what I do know because I stay on top of it the best I can because that is my business, but I don't do loans. So what's the rate today?
Well, rates today you could just call it in the low 4s. The actual rate depends on, there's so many factors that make up what the actual rate
all
is.
The time as well.
And so if you look at columns, across the top, and I'm just talking conventional loans. I won't talk FHA or VA because those are kind of a different animal. They're sort of more stable. But if you take 620 credit is the minimum credit it takes to get a conventional Fannie Mae or Freddie Mac loan. And in Maricopa County here in Scottsdale surrounding areas, the maximum loan amount is $510,400 for a conventional loan. You need a 620. The highest rate where you don't get any better pricing at a credit score, or not the highest rate, excuse me, the highest credit score is a 740. So now, and they go by 20-point increments. So now imagine on a spreadsheet, on a column, starting from 620, 640, 660, 680, 700, 720, 740. Now take those columns. Now your down payment has to do with what rate you get also. And the lowest down payment for conventional, first-time homebuyer conventional is 3%. That's the most expensive rate, is the minimum down. Then it goes to 5%. And there's a pretty big price difference between 3 and 5%. Then it goes 5-point increments from there. And I'm talking down payment. So 5% down is a 95% loan to value. Then 10% down, 15% down, 20% down, 25, 30, all the way down to 40%. So 40% down, matched up with the highest score, a 740 credit score, that's the lowest rate.
Right.
And right now, I mean, depending on the lender you look at right now, that's, a 4% or a 3.8, depending on what time of day.
It's funny because this kind of leads me a little bit to something else, because again, the media and different news stories and things like that you hear, it's like, oh, the interest rate is so low, which it is. I mean, it is historically low, right? Historically low. But there's always caveats to that, which is what you just explained.
Right.
Everything, the encompassing package is how you actually ultimately determine what your final interest rate is going to be. It's not, there's no
Right.
blanket, this is boom, this is what the interest rate is for everybody across the board, which leads me to just a little, I just have to say this because we're being inundated with marketing and media and all of these, all of this information right now that is good and bad. Let's just call it what it is. I was just reading something just the other day. I think it was just yesterday, and the title of it says Bank of America says the recession is already here. Jobs will be lost. Wealth will be destroyed. Okay, super super scary headline. Really scary headline. Okay, I read the whole thing. Let me just tell you what the last sentence says. The very last sentence. And you unless you read the whole thing, you're not going to get the very last thing. Although the decline is severe, we believe it will be very short-lived. So again, just I caution people, right,
Yeah.
on some of the stuff that they're reading and seeing because it's that clickbait people talk about. It's
It is.
get me to click on it. Again, it goes back to the interest rates. I see it all the time with
It's
all of these
it's absolute
online lending forms.
absolute clickbait,
Yeah,
especially online, and some you'll see bankrate.com, and they'll put that out there,
yeah,
and they will typically, and there's a lot of fine print there also,
mm,
as far as, but they're typically putting the lowest possible rate, with zero compensation, no broker or banker margin built in, with sometimes if you look at the asterisks, some of those are built in with a 1 point discount fee
right,
at a 40%, 60% or less loan to value
right,
with an 800 or higher credit score. Now, most people that are buying, there are a lot of 800 credit scores putting 40% down. Literally just got off the phone with a client doing that exact thing.
right,
But most cases are between 10 and 20% down, somewhere between 680 and 740 credit score,
mm,
and it just depends. But also you're going to find there's two channels you're going to go to, as while we're on interest rates. There's two channels you're going to also go to as well, and it's kind of like if I want to go buy a kiwi, I can get a kiwi at AJ's, or which is now the new expensive grocery store versus Whole Foods, because now
right,
with Amazon prices have come down a little bit. But
right,
if I go to AJ's and I pick out the one and I buy the one kiwi, it might cost me, I don't know, $3, because I'm going to the retail store and they've got a lot of overhead there, and it's a very beautiful kiwi, um, and I buy it. But now if I go down to Costco, and the price I pay for the box of kiwis that I pay, is going to be much cheaper because it's
right,
wholesale,
right,
and there's less overhead with wholesale.
right,
They don't even take them out of the box. They just put the boxes on the shelves and you buy the
right,
stuff. So, um, sometimes those stores like AJ's are going to Costco, getting the wholesale boxes, and then individually selling those. The
right,
same thing happens in the mortgage market and in the lending market. If you're dealing with a retail bank, especially a retail depository bank like a Wells or a bank, you go down and you talk to Johnny Cubicle there, that's there from 9 to 4:30, and that's the only access you get. You've got the retail deals, you deal with higher turn times, but then there's lots of other mortgage banks that are retail, and those mortgage banks have to charge underwriting fees, and they have to charge, there's margins built into what rates they're selling,
mm,
because of the overhead that retail location has, um, with all the managers and
right,
the senior managers and the senior managers. So if you're dealing with a bank, you're dealing with retail prices. If you're dealing with a broker, a wholesale broker,
mm,
they're taking those loans directly to wholesale. They're not having to charge the bank's underwriting fees. and you cut out a lot of margin. So if you're looking for the lowest rate, you have to deal with a wholesale broker.
Right. So here's the big question on
how it
everybody's
is.
mind that owns a house already. Should I refinance?
Well, and that's a case by case situation. So I had somebody call me that called up and, oh my gosh, I heard everybody, I need to refinance right away. And so I'm like, okay, hey, sure. I mean, if you're in a position where the rate now currently accessible is much lower and can save you a lot of money than what you currently have, then you should refinance. And I said, send me your mortgage bill. So they sent me the existing mortgage bill. They're sitting at a 3.5%.
Right.
It's like, well, I mean, maybe I can get you a 3.4, but you don't have to refinance if you're like at a 3.5%. But if you're at a 4.5% or a 4.25 or higher, and we taper back down into low threes, and that's what I always say. Side note: when people ask me what the rate is, you get asked what the rate is. I get asked what the rate is like everywhere I go. Holiday parties. Hey, what's the rate at today? It's the number one question my mother-in-law asks me every time I see her. So what are the rates? And I always give a range, high threes, low fours, mid fours.
That's the honest truth, is the range, right?
Mid threes, right, depending. So, but as far as refinancing, it also depends. I mean, a lot of people have taxes and insurance. Just an example, a lot of people have taxes and insurance included in their mortgage payment, right? And if I'm refinancing right now and I'm closing in April, well, the April taxes are just about to be paid, but they're not going to yet shown paid. So in the refinance that I'm going to do, you're going to want, and everybody wants all these things rolled in too. They don't want to write a check for taxes and insurance to refinance. So we roll in 6 months of your property taxes and another 2 months of reserves and 8 months of your homeowner's insurance, so that you'll have enough in your escrow balance to make the payment. You've been saving in your escrow balance currently with the lender you have, but if you refinance, we're paying off your existing lender. So the mortgage you have will be paid in full, and you get a new mortgage with a new lender. They're then going to need the money to pay your taxes and insurance that you've been saving up in these other guys' escrow account,
right?
Which they don't transfer escrow accounts. So then the new company, we got to take that in reserve, and then you have minimal title fees. Depending if you go to a broker or a banker, you're going to either have underwriting fees or you're not going to have underwriting fees. I'm in the camp of not having underwriting fees, but you're going to have your title fees and stuff, and you roll that in, and your payoff is going to have some added interest. And let's say that I owe $400,000 on my home, and my new loan, because I want to roll in my taxes and insurance, is going to be $405,000. Well, if I'm planning on selling next fall, I shouldn't, even if I'm at a 5%, it doesn't make sense to refinance, because now I'm just going to raise my principal balance right before I sell. So whether or not you should refinance depends on how long your expectation is of being in the house. It depends on how long you're going to roll, how much money you're going to roll into the loan, and then how that compares to what are you saving per month by refinancing. Now, if you have an adjustable rate at a 4% and you're going to a 3.75 and it's a fixed rate, absolutely. Get out of the adjustable rate while the rates are low, and get a low fixed rate. Even if it's the same rate you have now, get it fixed, especially if you plan on being in the house. And this is not only, you got to think too, not only do you plan on living in the house, long term, but do you plan on owning the house long term? Because I may have a house now, but I may want to buy a new house next spring. But I don't want to sell my house now because I know I can rent it for a lot of money, and I want to start building a real estate portfolio. So I'll do a low down payment.
All the things change.
Well, across the board, an investment property for most 80% of lower loan to value, an investment property at 75% and lower will cost 2.125% in a fee for the same rate as an owner occupied home. So the reason that the rates are higher for an investment property, it's not that the rate is higher, it's that the cost of the rate is higher.
The cost to get the loan.
Right. So the same rate, if it's a 4% right now on a primary residence, you can get a 4% on an investment property, it's just going to cost 2.125% discount fee. So in order to avoid paying the 2% discount fee, and on a $400,000 loan, that's $8,000, you take a higher rate that doesn't have that fee associated with it.
Right.
So you absorb that cost into the rate. That's why the rates are higher.
Right.
Typically about 3/4 to a 1 point higher. So if you are considering keeping the house you're in long-term, even if it's for rent, then it all depends on how much you're going to save, and how much it's going to cost.
Right.
And then how long, if you own the house for more months than it is, to recoup that cost, then it makes sense.
Right. So I've talked about this a little bit, and I know we talked about this a little bit, and to give, again, just a short little a summary of how we are in different times in 2008. 2008 was long ago, yet not so long ago that people aren't still very in tune with how they felt in 2008 with what happened in the
Right.
market.
And they were afraid to buy houses.
When they were afraid to buy houses, they were.
After.
It was scary. I mean, let's call it what it is. I'm not one to sugarcoat things, right?
Yeah.
And I've been talking about this. This is very, very different than 2008. It just is. This is not a symptom of the loan, the bad loan.
In regards to
the banks.
Right. In regards to real estate
Yes.
and mortgages.
Yes.
This isn't anything at all like 2008.
No. And
2000. Yeah.
Yeah. So, I mean, I've been, again, Michael Orr, I don't know if you have follow him, but I do very, very closely. Mathematician, Oxford, educated, extremely smart man, has been analyzing the market since before. I keep saying this about just so that everybody knows, been analyzing the market since before the crash. So there's a lot of data behind what he has. It is not, he didn't just start doing this last year or, when the market was good. He's analyzed the data now through a very, very big downturn. And so I've been trying to share a little bit about what's been going on. And again, understand this is very specific to Maricopa County in Arizona. But just today, a couple of the things that he said were, so the Cromford Market Index, for us to get to a normal balanced market, needs to get to 100. We've been about 200 or more. And in Scottsdale specifically, we were just right under 200. And we've been sitting there for a long, long time. We're starting to see that fall a little bit, but we're still so high. He said today that we are still well over 200, and that Cromford Market Index has to drop below 100 before pricing is given a downward pressure. So a good thing to know. Then again, because he analyzes all the data and some of the things that people are seeing, and I don't know, I mean, I am, because I'm just staying so in tune with everything that's going on. I'm like hyper aware right now, where normally I'm just really, really aware. Is that what we're seeing right now is we're seeing an influx of inventory coming on the market for a few reasons. One, a lot of it is in the lower price point. A lot of the people that own the Airbnbs and the VRBOs, because this is our hot season right now, their businesses, they just don't have people coming for occupancy. So we're seeing some of those come into the market. So we're starting to see a lower price per square foot overall in the market closing, but that's very normal because the price points on those homes are usually a little bit lower. But again, he's saying that do not be surprised and be prepared for this to be a widely misinterpreted as a fall in home values, like all of this. So I just, again, caution everybody so much in what they're hearing. Make sure the information you're getting is from trusted people and people that are in the market, in the business that you're looking for. That's one of the reasons why I talked to Roland. I talked to my financial advisor. I talked to, another financial advisor. I've talked to, probably 2 or 3 other or market lenders, just so that I stay up to date and get kind of everybody's take to share with my clients. I just think it's so important.
Well, and Sean, I think
about this yesterday, just kind of briefly. So again, back to just the reality of what this is. So people are scared, and rightfully so, right? We don't know what this totally means. My belief is, and my hope is that we are all staying safe and sane. It's kind of my new little thing, is safe and sane. But
That's a good, you should trademark that.
I thank you. I think I should too.
That's good.
So we're faced with that. So there is some relief for homeowners. So talk about what that looks like. How can they get that? What do they do?
Well, it's, and I was just reading an article on that, and it's sort of similar to the TARP plan, and the HARP plan that came out, and that was the kind of the modifications and forbearances on some of those loans. But I think you had a really good point in distinguishing the market turn down and signs of recession right now that's going on versus what 2008 was.
Right.
And because in terms of real estate and mortgage financing, it's night and day. 2008 was caused by the mortgage-backed security market. There was Wall Street greed, giving loans out to people that frankly had no business getting the loan, to buy houses with no skin in the game, no money down, no verification of employment, total garbage deals on 2-year arms that were a ticking time bomb to implode. And if they didn't refinance out of it, their payment was going to be unaffordable to them, even though it was already a little unaffordable. And if they didn't refinance out, they were surefire going to be, not able to make their payments.
Right.
And then when all those people that got all those garbage loans that were packaged up as if they were 40% down, 800 credit score, and these were like 520 credit score, and the names of the loan programs in 2005 were named after how many months you were already behind on your current mortgage. The 1 times 60, the 1 times 90, 1 times 120. There was even a 1 times 150 loan, which is 1 month before foreclosure. Lenders were giving loans to the homeowners with cash out. I mean, so the paper was saying, here's a really nice 800, what always used to be 800 credit score, never going to default. And this is A+ mortgage-backed security paper. Don't worry about it. Get your investors to buy it. It's beautiful. It's great, right? Turns out it wasn't. And then all of those banks disappeared overnight in March of 2007, 13 years ago this month. All those lenders shut down overnight.
Right.
And then all those people that needed to refinance out of those adjustable rates, when time came, there were no loans for those people. And then their payments went up anyway, and the government wasn't bailing the people out because you should have read the papers you signed. You signed into the loan. So they were almost sort of blamed as being part of the problem for it. So that whole crash was based on bad business practices, not a global virus that came out of nowhere. And the difference is we already have the Federal Reserve saying, we're not letting the mortgage-backed security fail. We're pumping unlimited amount of resources into it. And then the help that's coming out now is that they're looking at Fannie Mae and Freddie Mac backed loans. Now, just because you pay SPS, Select Portfolio Servicing, or you might pay Cenlar, or you might pay SunTrust, whoever you're paying your mortgage bill to, those are ultimately Fannie Mae and Freddie Mac. Mm-hmm. Those companies that you're paying, most of them like Cenlar or Mr. Cooper, or these companies, they're just simply loan servicing companies. They just collect the payment for the investor. They're like the property management company for the homeowner.
Right.
If you rent, you're not making your check to Mr. and Mrs. Smith. You're making it to Arizona Property Management Company, right? If you rent from a property management company. If you have a loan service for Fannie Mae, you're not paying Fannie Mae. You're paying these other servicing companies. So the loans that are with Fannie Mae and Freddie Mac, there's been announcements that they're going to work with borrowers that are directly affected from COVID-19 in terms of loss of income and unable to make payments. I lost my job because my company shut down for COVID-19. I no longer have a job. I can't make the mortgage payment. They're working out forbearances. they're, moving, kind of deferring the payments
Can
to
I
the
stop you?
end.
Hold on. Stop. Explain
Yeah.
what a forbearance is, because I don't know that some people know what some of these things are. So I don't know that they would know. Who reaches out for this stuff? Who says?
So the borrower, the homeowner, if you have a financial impact from COVID-19
Mhm.
that's directly affecting your ability to make your mortgage payment, you need to call your mortgage servicer. You start with them. They will then say, okay, thank you very much, and then get you in. It's just like the home modification loans that they were doing for people on adjustable rates, and some
Right,
people were getting the principal. Some people were getting their principal balances modified down based on income. Now that we know how much money you make, prove us what you make, and the banks were dropping the rates to 2% and dropping the principal. So what a forbearance is kind of like a rework of the existing loan,
Hmm.
or sort of taking what you owe now and moving it to the end of the loan for you. So it's sort of basically a modification,
Right.
right?
But
So you're modifying the
there's help.
current loan. There's help, and supposedly what I heard, and a lot of it's just been talk, right? Until there's an actual bill passed and a law made for them to do it, like the HARP,
Mhm.
the home
Mhm.
modification plans and all those
Mhm.
things, which were actual laws that Fannie Mae and Freddie Mac had to follow. Right now, it's, hey, we're going to help you. We're not going to report you late. When politicians say, we're going to do these things and don't worry, this is what's going to happen. We're sending you money. We're going to send you $1,000. It's like, and then everybody's going, okay, awesome. Where's my $1,000? I'm getting
Right.
$1,200. Where's the money? When does it come? When does it come in the mail? Where's my $1,200? Right. Well, I mean, there's got to be details worked out on that, but we're going to get the money out there. And
Right.
and now what you're seeing is, well, it's stuck on the Senate floor because our blues and our reds can't agree, and it's so things that are said are going to happen, then have to become written bills and laws, and then those go into place, and then you can do it. But right now, currently, I do, I mean, you just need to call your servicer. You have to call the people that are taking your loans because they're starting to get calls. The
Right.
federal government, Fannie Mae is not going to call you up and say, well, we're just going down the list and looks like we've got your loan, and we just want to tell you, don't have to make your payment. We're all, on lockdown, so just don't worry about it.
Right.
I mean, you have to call.
Be
And if you're
proactive.
not, you absolutely, you're the homeowner, the one that's supposed to make the mortgage payment needs to be the one to call the bank and say, I can't make the mortgage payment, and here's why: I'm directly affected by COVID-19. Make
Right.
sure you say, I'm directly impacted by COVID-19. What do I have to do to get a forgiveness of, or push my payment to later?
What do I need to do? What are you offering? How can I
What,
get help?
right? Call your lender, and
Yeah.
they'll tell you. And what you might get is, we're not sure right now, but let me get, I mean, I don't know. I haven't called,
Right.
but you
Well, and I
you need
remember
to
the beginning of
call
the
the
short
number.
sale. Yeah, I remember the beginning of the short sale days and dealing with, the short sales that were going on, and I standing on the phone for hours with lenders,
Yeah, same here.
hours, with the paperwork, and I've got 5 offers. What do where so it is a learning curve
Right.
and it is a learning process, but I mean we got through that. I mean, as much as we're saying this is
And
very, very different,
hopefully,
it is.
it's a short-term thing. This whole COVID-19 thing is, I mean, the whole point that they're trying to get out there is, if we just go, hey, time out. We're just going to take a time out.
Hmm.
Everybody go to the bench, and we'll start the game once we make sure that nobody's sick. I mean, because theoretically, if every single person did not come into contact with any other person and incubated themselves for 15 days, which is what the CDC and the HWO are saying is the amount of time for this particular coronavirus, which is the COVID-19 virus, which is sort of SARS-2, if you start studying into it, and it takes its course in 2 weeks. So theoretically, if everybody shut themselves in for 2 weeks, then nobody then has it anymore. and everybody can come out and play and everything's back to normal, right?
Right.
The problem is that, you're not getting everybody going, hey, sounds good. I'm
I
just going to be
know.
in my house. So it's just spreading and spreading and spreading. And then the more it spreads, the more new cases. And then that goes on the news and people freak out. And when I say people freak out, I mean investors and companies that shut down. I mean, I just spoke with somebody, if you're a fan of the Twisted Lizard,
Yeah.
they've closed their doors.
Yeah.
They're not reopening.
Mm.
Like they're done. So
Yeah.
these little bars now, they were not getting a whole lot of foot traffic anyway because
Mhm.
they've been kind of pinched by a lot of the new bars opening up, the
Right.
Vig and the
Right.
Whining Pig and
Right.
Sophia's Kitchen and all these places. And so they were kind of getting pinched anyway. But so that's what you got to think about. Any company that was already naturally struggling just due to natural competition in the marketplace, they're gone,
Right.
right? But something new will come into place, and it'll go through that. And so it's just, man, it's tough. But the difference is this is hopefully a short-term effect. It will have long-term, obviously, effects. And my heart goes out and prayers go out to the families that are financially affected by,
100%.
COVID-19, because it's not your fault, and it's not,
Well, and here's my reality, right? Everybody's affected by it. Everybody.
right.
It doesn't matter. Every single person is affected by it. We're all
Yeah,
having to
right.
make massive sacrifices to try to help in stopping what's going on. It's what we have to do. But I can say this again, in going through, I mean, I've been through 9/11, the stock market crash, the last 2008, when the market crashed there, and now this. So I've been through, a few, and it always comes around. The length of time is never known. And so my
Right.
hope is, and to kind of give you, I don't know, for people that are thinking like real estate is stopped, nobody's out there buying. No, I have, it's not
It's
true.
not happening.
The other lender that I spoke to today, he's like, I have 45 deals right now that I'm working on, that are pending. Which
Right. And I have a ton of people in line for refinances, but also purchases. I've qualified 2 new home buyers today.
right. I have a
There might
listing
be
that I got 2 calls on. Yeah, I got 2 calls on today because I have a listing, and my sellers have we have very clear rules on how things will go down. That has changed drastically. It is not a
right.
free for all and hey, let me just open my doors and you can come through. It is not that. But thank God I do
Yeah.
videos of
And
my
that'll
houses,
change.
so I
That'll
have a lot of
probably change.
information to share with people before they see it.
And
What's that?
that will most likely change forever. I mean, there's going to be some new realities that we will have for the rest of our lives.
Agreed.
And maybe, it turns into, you're going to see a lot more people walking around in masks, which is fine, because that's good.
Yeah.
Because if they have something that can cause a global shutdown, then you wouldn't want anybody else to get it.
Right.
But if you look at the map of cases and deaths of COVID-19, the United States map, all you got to do is Google it. And the one map I saw is red, and they have, I'll see if I can pull it up quickly, but there's not a lot of red here in Arizona.
Right.
So we've been really fortunate to not have, we're not the major metropolis, even though Phoenix is growing very, very quickly. And I think we're up to like number 5 in the world, or I mean, in our country as far as population, city-wise. But it is, rapidly going. California, New York, Chicago, Louisiana's getting banged down in New Orleans because they just showed a clip of Bourbon Street and it's packed.
That's crazy.
So Arizona's, I mean, as far as real estate, I mean, still a place that people are want to come because of the heat.
The call I got, one of the calls I got, the guy is selling his house. He's closing in 2 weeks in Austin. Needs to look at houses this weekend. I said, here's the video. Here's the video and here's the floor plan. let me know if he really, really wants to see it, and then we'll FaceTime.
Yeah.
You're not getting in the house. I'm really sorry. That it's just the
It
reality.
should cut down. It should cut down the looky-loos, and and get serious home buyers. But I'm seeing serious home buyers. I'm seeing, and from what I'm hearing from the experts in the mortgage-backed security fields, that you know interest rates are most likely have a very high probability of remaining low for a very long time, which is very good for the housing market. It's very good for buyers. It's going to keep prices affordable. Will we get a little blip where sellers are going to freak out? And there's probably some buyers out there that are going to have to get out of the game because they just lost their job and they can't buy a house unemployed, right? So we're going
Very
to see
unfortunate.
that. There's going to be some natural progression of that. So I think that's going to kind of shift um, the seller market that we were kind of heavily in. I mean, we were like, low inventory, house goes up. And I mean, I have buyers that were frustrated because they made an offer and there was 9 offers in the first 3 hours that the house went on the market, and they didn't want to go over purchase price, and they didn't have 40% down, or they weren't cash and they weren't getting it. So you're actually going to, although you're going to lose some buyers, you're actually going to get a lot of other buyers that maybe wouldn't have had a chance
Well, for
before.
those buyers, yeah, those buyers that were missing out, or kind of missing out on the multiple offer situation, it, and I've said this, like, this is a buying opportunity
It is.
for those specific buyers. So for those people that are out there in the market,
Right.
this is a buying opportunity. I would not be really scared. I mean, real estate is and always has been one of the safest, most secure places to put your money. Again, 2008 was long ago, but not that long ago that people remember the downturn. But in Scottsdale,
Yeah.
we were the last to feel it, and we were the first to recover. And that's one of the things that I had told people throughout the whole time, that Scottsdale, in and of itself, the city, is such a desirable place to live that people, I mean, we're in the midst of this and people are still wanting to move here. So I think that's good. And so I want to end this, as we have been talking for a while. We said we would do this for not a long time, but hopefully this has been valuable information for everybody. But I just want
Yeah, I
to,
hope. And thanks so much for bringing me on
of
to,
course,
your audience. And,
of course,
if anybody has any follow-up specific questions, I'm more than happy to have one-on-one
reach out.
conversations.
Yeah, reach out for
So,
sure.
throw my cell phone number out there or whatever.
Absolutely, absolutely. But I just want to encourage. This is one of the things that I've always been like, with all the times that I've been talking. The thing that I've been kind of ending on is that we are all being asked to be isolated, and isolation is hard um, for a lot of people. So please make sure that you're taking care of your mental health. Right now, it's really, really, really important. So although we have to stay apart, you can see how the world is changing. There's technology for us to still become connected. So
Yeah,
for that, please make sure you reach out to, anybody. Reach out to me. If you have nobody to reach out to me. I'm here. I will talk. I just think it's very important to make sure that we all just stay connected. It's human nature, and
absolutely.
it's necessary.
And my only advice too, and because I've caught myself doing this on phone calls, when you call your mom or your brother who you haven't talked to in a while, and you call your family members and friends, and really try to take interest in what they want to do in the next year of their life, where they're at, try to connect and keep conversations about an interest in that person you've just called, and find out how they're doing, what their favorite thing they did last year was, and maybe one big audacious goal that they have that they want to do in the next year, and try your hardest to keep those conversations off of, oh my god, did you see the death toll in Italy today?
That's going to
Because
help.
I'm finding that and it's so hard to not get on the conversation of COVID-19. And then once that goes, you start wondering if, you turn into a conspiracy theorist of your own. And then all of a sudden, I'm more stressed than when I called my friend.
Right.
So, let's connect with each other, and really just check in on, not how are you doing? Are you scared? How's it been going? What
Right.
you know
Well, and I think
what
yeah,
book have you read lately?
right. So I hope that everybody is well. I hope that this information was valuable. If Roland or I can help with anything, please feel free to reach out. Um, and I just wish that for everybody to stay safe and sane. That's all I
Likewise.
got.
Thanks so much,
Yeah.
Sean.
Yeah, you're welcome.
Thanks
Have a
for your
great
time.
day.
You too.